The dividend cut was very much so expected, but they're tying it to climate change. They're tying it to the virus. But as Javier makes the point on the TLive blog, this was really a long time coming, wasn't this?
Yes, I mean, it's quite a U-turn, Anne-Marie. As recently as at the end of last year, for the fourth quarter of 2019, Bob Dudley, the outgoing CEO, raised the dividend. And that's really just months away. So it shows how quickly, the pandemic has upended everything for the oil industry and forced them to reverse course, and two, how quickly the new CEO, Bernard Looney, has shifted ambitions for the company and is really giving himself financial headroom, to transform the company for the energy transition.
So the headline on the TLive blog right now is less dividend, more buyback. And it's actually, when you look at it, because they raised the dividend previously, not really a bad yield. Still 4.4%. That compares with 4.3% of Enel. I'm just reading over Javier Blas's shoulder like everybody else this morning. But it's not so bad in comparison, is it?
No, and I think that reflects the extent to which a dividend cut was already priced in by the market. I mean, we're seeing, it's really interesting, that comparison of dividends between oil majors and utilities. I mean, previously, people would have tended to expect higher dividends from oil majors because it reflects more volatility, more risk from the oil cycle, and better returns historically that the oil industry has adjusted. But we see this sort of convergence between the utilities and the oil majors as the oil majors get ready to prepare themselves for the low-carbon age and move into power generation and power trading, traditionally businesses dominated by utilities like Enel.
Will, how do they get their gearing down? It came down a little bit, less than what was estimates, but it's still well above their comfort range of 20 to 30%. Isn't this something that's really going to weigh on them?
Yes, but I think that the dividend cut will give them a lot of room to do that. They've outlined the fact that they won't increase buybacks markedly until they've reached a debt target given in their new strategy. And I also think that the company's probably set for a lot of divestments. We've seen that already. I mean, earlier this summer it outlined a $5 billion deal to get out of the chemicals business, for example. And today, in the part of its announcement, which looked at what its strategy was to shift the business in a low-carbon direction, it outlined that it's going to divest a lot of oil and gas assets as it tries to get oil and gas production down 40% over the next decade.
The other quick thing we need to talk about, Will, is trading. Trading obviously helped BP this quarter, but it also helped Shell, it helped Total. Is this all just the deep contango trade?
Yeah, absolutely. And this is a pattern we've seen repeated throughout the industry, from Shell to Total to Glencore. I mean, traders make money in a contango market. Traders make money in an oil crash. And this was a classic example. And it's likely that BP, which had a very, very big trading department, made well over $1 billion from trading oil in the quarter. And, you know, in a way, Anne-Marie, it's just showing the integrated model works, that in a downturn, this trading capacity gives you a hedge to profit as oil prices fall and clobber the rest of your business.